All right. Good morning, everybody. We're going to get more jobs data today. It's going to be like that for the rest of the week, what little bit we have of it. The uh, the CTAs are kind of shaking things up a little bit. This is the SPX in white with the CTA position in green, and you can see had some shenanigans going on, right? A pretty sharp pullback. Didn't match the pullback that we got in the market. It seemed a bit more extreme than that, but then they ran it right back up again. So it continues to show we're not looking for, a significant sell-off event. Weakness, yeah, sure, that's absolutely possible, especially with the jobs data coming in or the lack of, right? There's been rumors that perhaps we won't see the numbers come out the way they have been because we got a new director running that spot. Same thing with the NASDAQ. The NASDAQ's in white here, CTA positioning in green, sharp pullback. And now it's running back up. It's not back to where it was. Of course, neither is price, but certainly getting shook loose, right? And look at oil all over the place. Gold and silver really caught my eye. This move in silver just feels a bit extreme. Gets us out of the range that we've been fighting in since April. And it is a higher high. If you look back here, this was the high and then another high and now another high. It's not getting us back up to where we were, but it's certainly in the right direction. Lots of strength in that precious metals. So whether it's silver or gold, look at the difference, right? Between that and silver. Gold down on structure. And I did a review on this chart a while back. Of course, it didn't look like this because things have changed since then, but they got out and gold just kept right on going. So they got back in and then it stalled out. So they got out and gold kept right on going. So they got back in. It stalled out again and they got out. Now it's running and they're looking to get back in. We've got this much, right? From way up here to way down there. So 0.2 to 0.4 or above, right? Maybe into 0.5. Lots of room for increased positioning in gold, even with it in that overbought looking breakout state. Right? You got to admit, I mean, there's some really nice patterns. The SPX Gamma flip point 6422. Mostly green around the world. The Dow just slightly in the red, but basically flat. China flat. Then we start getting into the S&P not up a quarter, but working on it. NASDAQ closer to a quarter. Europe, small caps leading the way. That's the theme that we have been seeing for, 6 weeks or more, with small caps dominating in the pre-market and then really just taking a back seat once the market opened. It's back. So just seeing finance juice. I guess we can jump over to it. Challenger layoffs, actual 85.97 and the forecast 62. Boy. Figured that would have shown up there. $86,000 job cuts in August. There it is, 85.979, just call it 86. And the previous was 62. So we're likely going to feel this today. It's the thing that everybody's looking at right now, especially since Powell was chipping his teeth in Jackson Hole. So ADP first, and then initial jobless claims. We'll get into the trade deficit. There's been talk, that since they deemed the tariffs were not legal, if the U.S. has to pay back, they're talking about billions of dollars that the U.S. would have to pay back in tariff monies that they'd already claimed. Talk about breaking the bank. What our deficit would look like at that point. It's only at minus 77.9 billion only. We got ISM services at 10. Really, the number is so close together, not expecting much out of that. It's the jobs, right? It's not this other stuff this morning. It's the jobs. By 8:30, we should have a pretty good feel for what we're going to get out of the market. But, you know, make no mistake, 9:45 with PMI and then ISM right behind it at 10. It's going to be a busy morning. I think this is just going to be a circus, this banking nomination hearing for Moran to be the Fed governor. I mean, say what you will about Powell. You really want that guy? Whatever. And then tonight we got Goolsby, but we'll be done for the day. At least I will be. And it sets us up for tomorrow with the unemployment report. Gonna be a busy morning, guys. But by the time we get through lunch, whatever we're gonna get, we should have it, right? And that at least opens the afternoon up for possible 0-day plays, iron condors, butterflies, verticals off the edges, whatever. Because we'll be done by lunch once Europe closes, right? Let's say it that way. The call and put walls, respectively, are still where they were. The put wall, it did move up just a slight bit. I didn't bother with the picture because it's been moving up and down within this range, and the range hasn't changed. So I didn't update with the picture, just the post with the levels on it. All of our levels are clustered really close together. Moving averages, call and put wall, volatility trigger, zero gamma, everything is all wrapped up in this very narrow zone. And I got to say, it's really dangerous to have that, right? I don't have an analogy for it, but man, it's just really dangerous to have everything clustered in that one little spot. The best I could come up with is the old adage, don't put all your eggs in one basket. You don't want all of your structure in one spot. That just, it's just really bad. One big jolt break to the downside and we have no net down there to help us out at all. Of course, you know, take that the other way around. We start running to the upside, and other than the way that the dealer mechanics would sell into that strength as we rise, that would be the only thing that would try to slow us down on that rally out. So either direction, you know, we really don't have anything position wise structurally to help us until we get down to at least the 50. Technically, it's possible that we could get down to 6,000 or the 200 period moving average, but that would be an extremely violent maneuver after headlines that, you know, caught the world on fire. So while it's technically possible, it's really not likely. 50 is way more likely if things were to get out of control today. And on the other side of that, 6,600 is really easy today. There's no reason to believe it's going to be that way, right? The numbers today aren't even the biggest ones. Tomorrow's the bigger numbers. And if there's going to be any shock and awe or drama, we're really expecting it tomorrow, not today. If it was today, we'd see market maker moves and they'd be hedging like crazy, and likely the volume would be a lot lighter. We're still looking at 54,000 on the day. And sure, I mean, that's a little light compared to what we had Tuesday and Wednesday, 100,000 and 90,000, but they're still in here and they're still participating. we didn't get much in the overnight, right? All things considered, a rising flat top wedge looking for a breakdown. And this is building up into a compression metric. So we just got to pop the spring and see which way it flies. Looking at the ADRs, we would need an inside day breakout to get to the upside. What we're talking about breaking out of is yesterday's high and yesterday's low. We already did get an inside day breakout. We expanded outside of yesterday's range, came back in, got back out again. I gotta say, normally if you break out of the range and you come back in, that's it, right? You had one shot, you failed, and you're not going to get another one. But we ran right back out again, and we're still outside of yesterday's range. I really can't see that we get back inside this range again today and then get back outside the range yet again. But we are setting up those higher lows with equal highs, not technically equal highs, they're higher, but that's a solid reversal pattern right there. Still, we're setting up into this compression metric here. So, I think if we head to the downside with the 830 print and the violence that comes with it, that it would just continue the move to the downside and we wouldn't get the opportunity to break back out of the box. Typically, you don't see price make this sort of mechanical move inside and outside the previous day's range. We are closer to the upper edge by a nominal amount. So, a default scenario is that we just keep going to the upside. 64.92 cog line would be an overshoot of that ADR line. There's no market maker move. They're not hedging into this. They don't see the concern for the additional hedging. So that kind of gives us some guidance. We are almost back to that weekly floor pivot. Almost. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. We tested the top of the pivot channel and it held. So we have an MDP. That's a missed daily pivot. The thing is, it won't count until tomorrow because at any point today, well, we could go down and we could hit this pivot and then it wouldn't be a missed daily pivot. It'd be a pivot that we hit. So at the moment, it's a missed daily pivot, but we won't count it until tomorrow when we look back and say, hey, look, we never hit that pivot yesterday. Default scenario is that we're likely to hit that pivot. It's what we do. Now, with yesterday being a narrow range, the SNR levels for today on that pivot should be a lot closer. It's likely we've already hit R1. And the concern is R1, S2. We'll have to zoom in and find that R1. 64.74 right there. It's just over our head. So we got really close to it. Close is okay. I'd like to hit it, remove the ambiguity of it. So yeah, we got near it. Maybe at 8:30, the violence pops us up there in a wicky, spiky sort of scenario, and we go ahead and tag it. But R1 equals S2, and S2 is 64.11 cog line. It's way down here. It doesn't have to run that way. We can go through R1 and get into R2 and continue to expand above it into R3. But at the moment, R1 and the weekly floor pivot are almost on top of each other. That's multiple structures of resistance overhead. We can get through it. We're just going to need a really good push. $300 billion? Really? That's the estimate? Nah. That won't hurt the budget at all. So as you can see, we're continuing to stack these points of control up on the weekly. And look, they're not lined up perfect, right? The previous weeks, they're not just forming a solid straight line because it's the real world. It's not some theoretical textbook, but they are all in this upper zone. Everything above 6450 is just getting defended, and there's a lot of structure up there that we haven't been able to get through. And the longer we keep fiddling around up here, the more footprints we're putting into place, more structure we're building that is going to hold us back. So we need a just shock and awe event to break us through that structure and beyond to the upside, or wash it out. And the thing about washing it out is, at some point, those big funds and firms will get tired of being the hamster on a wheel, running and running and running and running without actually getting anywhere, and they will wash it. They'll just start rotating capital out, and it'll collapse things down into like 6250, and they'll make another run at it. The way I usually describe that is, if you come across a sticky door and it doesn't want to open, what do you usually do? Back up, put your shoulder down, and get a little running start. When there's an obstacle in the way and price can't seem to get through it, eventually they'll just back up far enough to get a running start, and they'll take another run at it. Thing is, if they take another run at it and it doesn't work, then they really wash it out. But that's a lot farther down the road. We're not there yet. The main thing right now is that we need a really big event. Tomorrow might be that event. I don't expect it to be, but it could be, right? Because we got that new director, and there's rumors. So possible. I don't think so. Otherwise, in October is where we're going to start to see a lot of funds do their taxes, right? And they're going to be worrying about removing the stuff that hasn't been performing. So they'll sell out of that, even if they buy right back into something that is similar to it, but not too similar, to avoid wash rules. But there'll be a lot of changes next month when it comes to those funds that are dealing with the taxes, because it's that time of year for them. The threat there is they're going to be washing out things that haven't been performing this year. So what I like to do around this time of year is run a scan looking for things that are down on the year. Now you can use anchored VWAP, right? The year-to-date anchored VWAP. I really like that one, but it misses the point. You want to see things that are down on the year. You could just run it back, over the last 12 months, not from January to now. And whether or not it is higher or lower than where we were a year ago. So 1 year performance. If it's in the negative, take a good look at it. Make sure it's not in your portfolio. Nothing wrong with trading in it, right? Trading is a completely different thing. 10-day, 30-minute volume profile and TPO. The TPO, I mean, it continues to look really good. The volume profile, on the other hand, is an absolute mess. Big distribution structures on each side. We're working on this lower structure right now, which isn't really going to help us out. And then we're going to focus on this higher structure. There's no reason to expect the point of control is going to move anytime soon. And we're talking days before we even start getting into the candles that made this upper structure. We are at the point of control right now. That matters to where we are right now, right? When you use this thing, you can't look back here and think about how price was acting here, because the point of control wasn't there when we were here, right? It only counts right here. So I know it sucks that you could see all the way back, and it makes you think, oh, that it was supportive there and price was responding here and here, but it wasn't, because we weren't there at the time, right? The point of control wasn't there. It might be a little hard to grasp that logic, but if you go back to the morning briefing, and I do it every day and have been doing them for years, and if you just went to this part of the stream every single day and just take a snapshot of that point of control and where price is, and then look at it the next day and the next day and the next day, you'll start to get the point that it's only where we are right this moment, looking back here at what price was doing in connection to either of these three lines, has no bearing or insight whatsoever. I say that because I was just watching a video yesterday. Somebody had sent me about the point of control. They were asking questions, and whoever it was in the stream was talking about, and they were pointing it out. They're like, yeah, look how that's such a great resistance, and price was responding there, and blah blah blah, and then it broke out. No, it didn't. This profile didn't even have that shape when price was there 2 weeks ago, right? You just be careful what you're watching, who you're watching. Joe Schmo in his mama's basement, making clickbait on YouTube, ain't gonna help you out. We are at the point of control. We do have this rising wedge, and that is an issue. The breakdown of that wedge is at least 50% of this entire move, right? So this is the move that we're talking about. Cut that move in half. That gets you down to 64.32 cog line at the minimum on that rising wedge. We still have the VPOC back here, and in fact, we have a new one. So we're building structure underneath this. That keeps the argument for the bullish bias to continue to build the structure underneath this to help us out. Because, I mean, really, it's the only thing we got right now, looking down. So we got 64.11 and 64.47. There's an old point of control at 42. We don't talk about it that much because we don't really use 42 anymore. But used to be back in the day a big one. 47 is not 42 though. If we do break to the downside, we're looking at the underside of 64.50, really, right? If it was 64.52, then we'd be talking about a front run. And in this case, we're talking about them hiding behind 64.50 and putting the structure in underneath it. Looking at what we've got this morning, it's a really nice, clear distribution. You can see they're waiting, as we will be waiting. And we got nothing, right? They tried to put a little bit of work in last night, and that's it. So we'll see if we get back down into that level today at 64.55, which is a front run on the 64.50. We'll see if they put that work in again. We made it back to Friday's close, tagged it nearly perfect. And now we're holding back from that level, which, if we do make a move to the upside today, keep 64.74 on your radar. It's Friday's close, and price is respecting that level, as it always does, right? Open, high, low, close are some of the best pivots you could ever keep your eye on. And that's what we hit this morning. We're at the 10-day. The thing about being at the 10-day is it's a bit like gravity. You got to try to escape gravity with velocity, and well, we don't have any. So we can sit in this zone and just chop. Really, it's like a half up and half down, right? It makes a 1-point range or a 1% range. We can just stay in this zone and chop. And the thing is, it's not unhealthy. It is healthy. It gives the market time to heal. It gives the 10-week time to move into position. It's what we call digesting. So markets need a correction. We can get that correction in price just by getting a really sharp pullback, or we can get that correction through time where we just sit and digest the move that we had made and let things normalize again. That's what we're doing here, is letting things normalize and digesting, and it's healthy, but it continues to give us the upward bias too. It's still, this isn't negative. So I know it's easy to start looking to the downside, and there's nothing wrong with getting some short trades on, absolutely, because trades are trades. But I wouldn't go get all heavy bared up looking for this market to wash out. At this point, we don't have those signals. Especially with small caps up again this morning. It's the same routine that we've been doing for 6 weeks, right? With the small caps up in the pre-market, and then the rest of the market comes in after they open, and we just keep on grinding and grinding to the upside. This is the 5-day change over the 9 sectors we tend to watch. Every single one of them is red, orange. The one that is down the least is healthcare, and right behind that, staples. There's this wrong impression that if we start having a weakness in the economy, that the staples companies, the stocks down in like XLP, utilities, XLU, and XLV, that these three will do better. But when you're talking about growth versus value, it's not one versus the other. Both growth and value can be going up with value outperforming, and both growth and value can be going down with growth outperforming. So it's not just that one has to be up while the other is down. They can both be up, they can both be down. It really starts leaning into which one is outperforming. Seeing these down the least says that they're doing better, right? All of them are down, but these are down the least. They had the most supportive flows out of the bunch. But when we're looking for greater upside moves, we need a bit of a pullback. And so getting a pullback in the entire market space, all of the sectors, that's a good thing. Plus, the high flyers always pull back farther, right? If you run higher, you fall farther. It's just the name of the game. Gravity, it's how it works. So this pullback and all of these being negative is still not seen as a broad market reason to get negative. It's just a pullback. Now, there are some concerning individual pieces to any of this that you could look at and say, yeah, no, that's not good. Like XLI testing the 50 period, that's not good. Or energy getting a 50-20, 50-200 cross to the upside, right? That sounds good if we get it. So there are some things that can be looked at with some concern. Utilities already under the 50. Tech tested that 50, and for the moment it's holding. We start breaking the 50 on a lot of these sectors and getting underneath it, like staples, it's under the 200 at this point. Healthcare, it's under the 200 at this point, with the 50 also under the 200. Those are really concerning signals. Look at the white line is on every one of these charts. That's the Linreg line. At a glance, it gives you total market direction for that sector or that index, whatever you happen to put it on. So angled higher, 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 right, on all those, but they're flattening out on tech and consumer discretionary. Lower, lower on these two, but not sharply pointed lower, right? Just a gentle decline. Energy and building materials, but industrials is still pointing to the upside. Staples and healthcare down, with healthcare really down. And utilities up, looking not quite as good as financials, but maybe similar to tech. And it should be, right? Because we've been saying that utilities and tech are married now with those SMRs and nuclear reactors and the data centers needing all the energy. It's what everybody talks about with energy now is, oh, we got to have energy, 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 because it's tech. Can't run tech without it. Data centers are eating all the energy up, which is why they're freaking out over the administration canceling those windmills or the wind farm. They're like, we need the energy, bro. Don't turn the energy off. We need more. Everything causes cancer. Everything. I am a firm believer that Tupperware, those plastic bowls, cause cancer. We don't use those in my house. We use the glass bowls, the whatever they're called. No Tupperware in my house, especially if you microwave stuff. So don't ever microwave something in a Tupperware bowl and eat it. No, gonna get cancer. That's my, yeah. Think about it. If you've ever seen somebody's Tupperware bowl after they microwaved it with, say, spaghetti, and it had bubbled on the inside, well, the whole thing is made from chemicals. If it bubbled and popped, what do you think happened to the chemicals that was in there? You just put it in your food. And then they wonder why the American people are just cancer ridden like crazy all across the United States. People with cancer. I say it's Tupperware. Bitcoin is down. China's down. Precious metals are down, and then China, and then precious metals. And the Mag 7 down volume is down. Now, that's a good one. I know it's a double negative, but it means the Mag 7 is up. So that's a good thing. If we want to see a rally day, we want the Mag 7 on our side. But looking at things that are up, they're not up enough. Communications, bonds, quantum, chips, Mag 7, none of them are up enough to match. So what you want to be looking for this morning is that spark that really starts moving the Mag 7 around. The FNG up volume, the Mag 7 up volume is up almost a half, almost. So we're getting the flows, we're just not getting the moves yet. And tech is at support, so it's ready to launch off. Same with chips and the Mag 7 complex. We were just talking about IWM. We got IPO on support, Bitcoin, ready to do it. We just need to get it done, right? The question is, why would they do it right in front of the big jobs data tomorrow? I wouldn't, right? If I was running a lot of assets under management and I'm looking at tomorrow's job numbers with this crazy rumor that we might not even get any numbers tomorrow, I wouldn't try to get all bulled up in anything. So what do, right? If we get the spark, we start to see Mag 7 push where the 0 days come in, then we could get that lift. But I don't expect it in front of really big data tomorrow. And that's just the long and the short of it. Then you got to start counting how many Fridays are we from OPEX. So after this week, next week's going to be the only week we have because the following week is OPEX week. And that's when they're going to be rolling out that whole week. They'll be rolling out. So we got one more week before they start rolling and moving structure out of our way. With the big one at the moment being, what are we going to get tomorrow? I have no idea. Markets don't like surprises, that's for sure. So we got uranium, bonds, and that's it. You don't want a rally day on bonds and uranium. Bonds is kind of getting a little wild, ain't they? We got the year-to-date anchored VWAP just overhead, and we've been setting those lower highs and higher lows, forming a wedge. It's a big wedge, it's a big daily wedge, but still it is forming a wedge. Yeah, there's been a lot of talk about consumer spending and the projections for the holiday sales. Projections are down for sales like crazy. They were looking at the age group of shoppers and what the projected shopping groups were going to do. There was only one group that increased their spending this year for gifts and family, and that was people over the age of 50, I think. They were the only group that increased how much money they were going to spend on gifts and family. Every other age group reduced their spending projections. That's the projections. It doesn't mean that's actually what they're going to do. There was a whole big write-up yesterday that came out on well, I read it on Gamma Lab, but they got the information. It was either a Goldman Sachs report or one of the other. See if I can find it. Because you guys will be able to search for it, right? It wasn't Citadel. That one I would have remembered. That's a bunch of JP Morgan stuff. Evercore. It was Evercore. Pretty sure it was. Oh, shoot, here it is. It's not Evercore. Price Waterhouse Coopers, PwC. they ran this survey, and they run the survey every year, right? You can put it on your calendars and just look for it every year. They run it between June and July, and then they come out with it before the holiday season. This whole thing went into detail about the different age ranges of the projected spending, what they're spending it on, where they're spending it, if they're going to spend it at all. And then they had the generational differences, and they really just broke it down kind of nice. Now, none of that says it's what they're actually going to do, right? We've always said, follow the money. Don't, you know, listen to what they say, watch what they do. And they did make some references to previous years where people have said one thing and did another. But for the most part, it's a nice forecast of what to expect when it comes to spending. And they talked about how there was a discrepancy in, you know, uh, store supplies in the early part of the year, that they didn't get a lot of sales taken care of because they didn't have the inventory. And by the time they got the inventory, we were already through spring and into summer. And then they had to sell a lot of that stuff on discount. So they weren't even getting good prices on it. So some companies have just an abundance of stuff that doesn't match the season, can't be sold for the price that they picked it up for, and it's just going to be lost. It was a good read if you want to dig into it. It was the PricewaterhouseCoopers survey, and they run it every year. PwC. No, watch that YouTube video where the guy makes his own coal, right? Where he's like roasting these logs and then kills the fire while they're just good chunks of wood coal. Give away wood coal this year. Put it in their stockings. Anyways, it's what I got for you guys. We got a GTFO the box, right? You got to get out of the box. It's that way every time. Watch the clock. You got 20 minutes for the big guns to come in. And this isn't even the big day, right? Tomorrow is. But keep your eye on the clock all the way until Europe closes today, because we're going to just keep getting data all morning long. And then by the time we get on the other side of Europe close, you'll have the afternoon to do some 0-day plays or whatever. Be careful, be safe. I'll see y'all tomorrow.